Choosing the wrong business structure could cost you thousands or maybe even 10,000s of hundreds of thousands of dollars in taxes every year. Most small business owners make this mistake, but today we're gonna break down LLC versus S Corporation. I'm Rivkin, an expert in financial freedom and business growth. And today I'm going to share with you everything that you need to know about LLC versus S Corp. What is an LLC and S Corp? LLC is a limited liability company. S Corp, it's a corporation. It's a tax status of the corporation. It's not a business structure. And this tax status gives you potential tax advantages, which we're going to discuss in this video. All right, so now let's talk about the common features of LLC and S Corp, as well as the key differences. So the LLC is the limited liability company. So what it means is, it means that you have a limited liability and it protects your assets. It protects your personal accounts, your bank accounts, your house. So all the liability, that everything that is happening in the company, that stays in the company. So the same thing happens with the S Corporation. So it's a corporation, it gives you the same limited liability. So everything that whatever is happening in the corporation, then all these losses stay in the corporation and then your assets are protected. So the key differences between LLC and the S Corporation: the LLC it has the owners in forms of the members, while the S Corporation has the owners in forms of the shareholders. And another key difference is there is a limit of the amount of the shareholders that you can have in S Corporation. So the limit is it's 100 shareholders. So if you have 101 shareholders, you cannot. Versus the LLC, it can have as many members as you would like to have. Another key difference between LLC and S Corporation is that in LLC, you can have members that are foreign individuals. So they don't have to be US citizen, they can be living anywhere outside of the United States. In S Corporation, all the shareholders, they have to be US citizens. Another key difference between LLC and S Corporation is the management flexibility. The LLC offers flexibility where you don't have to have the minutes of incorporation because it's not a corporation, while in the S Corporation, you have to follow the corporate structure. And another thing, when you have the corporation, also you have to pay to the owners of the company that work in the company. So they have to receive the salary. It has to be the minimum salary has to be paid to the owners of the company. Versus in LLC, the members of the LLC, they don't need to pay themselves a salary. So typically the way they take profit, it's through the draw or just through the profit distribution. Another key difference between the LLC and the S Corporation is the administrative requirements. While the LLC has fewer formalities, the S Corporation requires you to keep the very good records as well as the compliance. Another feature between LLC and S Corporation, the similar feature, is the taxation. So while in terms of the taxation, some of them are similar in a way that both of them are the pass-through entities. So meaning whatever income or loss the LLC has or the S Corporation, this income and loss is going to get passed through to the members or the owners of the company. So this is the benefit, it's the similarity of these both structures. But the difference in terms of the taxation is that the LLC, when you pass through this income, it's subject to self-employment tax. While in the S Corporation, this pass-through income that flows into the personal tax return, you don't have to pay the self-employment tax. And this is one of the biggest difference in them, because the self-employment tax, it's a very high amount. We're talking about 15.3%. So in that case, let me just give you an example. So let's say if the LLC has an income of 100,000 and that income flows to personal tax return, that means that the owner of that LLC will pay an extra $15,300 in taxes. while if this would be an S Corporation, they wouldn't have to be paying that. Another key point that I wanted to point out is, while again we were talking about that LLC and S Corporation are both pass-through entities, the way the profits or losses being passed to the members or the owners of the company, it's a little bit different in LLC and S Corporation. So what do I mean by that? So the LLC allows you to allocate the profit as well as the losses, while in S Corporation it's only distributed based on the percentage that you own. Let's talk about, okay, as I mentioned before, let's say there's 100,000 in profit that in LLC. So let's say the LLC has 2 members, so and they both 50-50. So but in that case, one of the members, even though they 50-50, their portion of the profit is higher, and they because they did some kind of an extra work in the company. Let's say they were like a manager partner versus being an investor, and now they're earning more money and they allocating more profit to themselves. So now the way they can allocate any way that the agreement allows them. Let's say one of the owners can distribute to themselves 60,000 and the other is 40,000, even though both of them are 50-50 owners. The S Corporation doesn't allow you to do that. So in the S Corporation, if both shareholders are 50-50, this 100,000 in profit has to be equally distributed. 50,000 to one shareholder and 50,000 to another shareholder. Another key difference between LLC and the S Corporation is the complexity and the paperwork. While the LLC requires less paperwork to be filed and there's less formalities than S Corporation, the S Corporation has more of the administrative requirements, like including the annual meeting of the shareholders and then the formal recording, keeping of all these meetings. But then on the other hand, if we're going to talk about the key differences between LLC and the S Corporation, even though there is more of this administrative requirements that needs to be done, the S Corporation on the other hand allows you to establish different types of plans that will potentially give you more deductions and more benefits in terms of saving more money in taxes. And one of the key benefits that I wanted to share with you that the S Corporation allows you is to implement accountable plan. So what is accountable plan? Accountable plan, it's a system that allows you to reimburse your employees for the expenses that were paid on behalf of the company. So while the S Corporation allows you to do this, then the LLCs, they do not have this accountable plan in place. And then in the S Corporation, so we're talking about employees. The employees in that case, you can be you as the shareholder, so you can be an employee. And then in that case, you can reimburse yourself for all the expenses that you had to pay on behalf of the company. And then here's another benefit is that if you are the employee of the company and then you have, let's say, your family members as the employees of the company, then this accountable plan will apply to them as well. So that's another key benefit that allows you to save lots of money. And another thing that I wanted to point out, even though the complexity and the paperwork of the S Corporation requires you to keep all the records and the annual meetings, it's not necessarily a bad thing. And what do I mean by that? Let's say you are the owner of the S Corporation and you're a single shareholder. But then you as the shareholder of the company, you can have the board members. And in fact, it's a normal thing. I mean, look at these big corporations, Apple, Microsoft, IBM, all these corporations, like they have all these board members. And here is the key benefit of this. The board members, they don't have to be employees of the companies. So it can be outside people that you bringing into the company. And the reason for that is the biggest reason for that is to brainstorm on the growth of the company, on the development of the company. So in fact, it's actually even encouraged for the shareholders, for the owners of the companies to bring outside people to be the board members of the company. So now let's say you are the shareholder of the company and you're bringing this board members outside of the company, so not necessarily your employees. So in your case, listen, it can be your husband or your wife, your family members, your friends, or your children if they're already old enough. And then here's another thing. Whenever you're holding these annual meetings, okay, I mean, in reality, it doesn't even have to be annual meetings. You can have these meetings every quarter. Because if you want to grow your company, if you're brainstorming, you can have them every quarter. So let's say you're holding these quarterly or annual meetings, and then they not necessarily need to be in the office, in the place of where you conduct the business. So that potentially can be somewhere in Bahamas or in Florida or, like in any kind of place. So now look at it this way. You're holding this meeting, okay, you're flying your whole board members there, and then you're sitting and you're brainstorming, coming up with the ways of how to potentially grow your business, develop your business to improve the business structure, the business growth, the financials, the income, and then at the same time, you enjoying the Bahamas or Miami or Florida, wherever it is that you're holding this meeting. And that is fully deductible because that becomes the corporate expense, and that is fully deductible, meaning that it reduces your tax liability. So here's another thing that I actually wanted to point out to you. So while I mentioned to you the difference between LLC and the S Corporation, but here's another thing that is very interesting. The LLC can actually be an S Corporation. So I know it's probably like mind-blowing right now and you never heard of it or probably first time hearing this. So what actually do I mean by this? So the S Corporation, it's just the election, it's the status that you electing with the tax authorities. The corporation itself, or the LLC, as in what we're talking about, this is when you open the company, you file through the Department of State. So typically it's wherever your business is located. We have 50 states in US, so depending on which state you are, you're submitting these filing documents to the state, and then you're receiving the certificate. And then the certificate would be in form of the LLC or in form of the C Corporation. And then once you receive your certificate, then you have a choice whether you want to stay as an LLC if you're opening up the company as an LLC, okay, or if you're opening up as a C Corporation, you can stay as a C Corporation, or you can switch it to an S Corporation. So now let's go back to the LLC. So let's say you organized the company as an LLC. So from the moment that you organize your company as an LLC, now you have a choice whether you want to be treated as a single member LLC, as an LLC, as a partnership, or as an S Corporation, or as a C Corporation. And the choice it depends on the taxes, how you want to be paying taxes this year, next year, and the future years. And this is the most important thing that I think all the business owners, when they opening up and filing to be an LLC or S Corporation, I think like this is the biggest thing that the key point that they're missing on. So here's another thing that I also wanted to mention. So let's say you opened up an LLC and then you decided to stay as an LLC for the first year or for the second year of the business operation, and that's fine. The good thing is that every year as the year ends, you still have a choice to switch it to an C Corporation or to an S Corporation. And then we're going to talk about right now then what is the benefit of filing in terms of the taxes being an S Corporation or being an LLC or being a partnership or being a single member LLC. So now let's talk about this. The single member LLC, so typically it's if you are just one person opening up as an LLC, you don't have any partners, you are solely by yourself, so then in that case you file single member LLC. And honestly, I'll tell you that this is the most common way that I see business owners file their tax returns and the way that they treat themselves for the tax purposes. I think the main reason for that, obviously besides the fact that they're just one person, there's no partners, the biggest reason for that is that they're trying to save money because you don't have to file a separate tax return. So when you're filing as a single member LLC, so you're filing just one tax return, which is your personal tax return. So meaning you don't have to file separate returns. And then if you don't file separate returns, that means that you have to pay extra to your accountant. And I see this a lot. This is like the key reason, the key factor for business owners, because obviously no one wants to spend more money than they're already spending in terms of running the business. But there is advantages and there is a disadvantages in terms of that. The advantage obviously is that you don't have to pay extra fee to your accountants or to your tax advisors or filing an extra return. But the biggest disadvantage is that in all the reality, even though you have this LLC, even though it's limited liability in terms of the asset protection, but that for the IRS tax purposes, they just seeing you as the sole owner, this one personal tax return. And here's the thing. When you're filing as a single member LLC, so typically it's filed as a Schedule C on your personal tax return. And then you have all this income, you have all these expenses. The IRS doesn't like this too much whenever you're writing down a lot of expenses on your personal tax return. They don't like this a lot. And that's why it triggers these red flags. And this type of returns are the most returns that are being audited by the IRS. So I think like this is one of the biggest disadvantages. And another disadvantage, we're going to be talking not just about profits, but let's say if you have a loss, then what happens with the loss? If it's an LLC, then this whole loss, it gets to be deducted right away in that single year. And a lot of the times I see this very often, the owners of the businesses, they don't even need to deduct this loss. So let me just give you an example. Probably it's too complicated. Let me give you an example. So let's say if it's just you have the business and then you don't have any other source of income. So let's say the business, you made $100,000 in gross income and then you had $120,000 in expenses. So now you have minus $20,000. So since there is no other sources of income, this minus $20,000 doesn't do any good to you. Like you're not getting your money back. No one is giving you anything back. There is nothing to deduct against. But then let's say next year, the business started doing very well. So let's say next year, the gross was 200,000. You had 100,000 and all the expenses. And now you have a profit of 100,000. So then in that case, now you have to be paying taxes on this 100,000. But then you see like that prior year 20,000 loss is completely gone. It's completely wasted. You didn't get any benefit from it. It was used, but now you have to be paying taxes on this 100,000. So that's why it's very important, not just base the decisions on how you want to file your tax return and how you want to be treating as an LLC, as an S Corporation, but also base it on the bottom line. And the bottom line is, how much income are you looking to receive? Or maybe loss. Do you need to deduct this loss? Or do you need to hold down to the loss and maybe carry it to the next year? So now we spoke about the single member LLC. So let's say you have partners. If you have partners, then you can treat your LLC as a multi-member LLC. So the biggest difference in that between the single member LLC and the multi-member LLC is that now you're filing a separate tax return. So now you have two tax returns. You have your personal tax return and then you have LLC tax return. And whatever money you earn in the LLC minus all the expenses, this income or the loss, it all flows to the personal tax return. So in that case, in terms of when I was talking about single member LLC, that these are more the returns that IRS loves to audit. In this case, when you're treating yourself as a multi-member LLC, you have a separate tax return. It's already considered as the company, as the separate entity. So the IRS typically, I mean, listen, there's always a chance that IRS will audit you. But in that case, the bottom line is that you're having two separate tax returns, which is already great. Everything else in terms of like the income, how it flows, how you pay taxes, it's all going to be the same as in the single member LLC. Then another way you can treat you for the tax purposes, you can treat your LLC, you can treat it as a partnership. So typically it's going to be the same thing as when you have the multi-member LLC, the same tax structure will apply. So if you decide to be treated as a C Corporation, that LLC, then you file the election with the IRS and then you file what it gives you. It allows you to file a separate tax return as a corporation, and then you pay the taxes based on this corporate structure. And this is where like the difference comes into the place. Advantage of the LLC is that you don't pay this double taxation that we're all hearing about, right? Because what it means, the double taxation is if you're earning a profit, let's say if you have $100,000 profit in the company, then you don't pay the taxes in the company, it flows to the person in the personal tax return. But in the C corporation, if you have the $100,000 profit, then you have to be paying taxes based on that corporate level, on the corporation. So let's say you have $100,000 in profit, you pay $15,000 in taxes, now you have $85,000 left, and now you have to distribute them among the shareholders, and then you have to pay taxes again. So this is what double taxation means. Or in that case, to avoid double taxation, you can always also treat your corporation as an S corporation. You get the same tax benefits as an LLC. It's a pass-through entity. You don't pay double taxes, but you save 15.3% on self-employment tax, which you still have to be paying on LLC, but not on S corporation. So the bottom line is, I know I gave you lots of information. You know, whenever business owners, whenever they are opening up this LLC through their accountants or doing it themselves or maybe through attorneys, I see this a lot, that the main factor for them, the main deciding factor in terms of like how to structure the company, it's because they're trying to avoid paying this extra fee, for the tax advice, for the professional advice. But in reality, is it actually worth saving money on this advice fee versus losing in the taxes? And let me give you an example what I mean, because I see this literally every single day. I do this express audits, and then new clients come in, and the first thing that I see is that they're filing their tax returns as an LLC. So majority of them file as a single members LLC, meaning that one tax return, and obviously the decision factor is because they're trying to save money on this accounting fees, on the tax professional fees. But then when I do all these calculations and I show to them is actually how much they're losing versus how much they're saving. So while you're thinking, okay, you know what, I'm saving on all this accounting and professional fees, okay, and I'm not making any money. That's exactly what he told me. He said, like, I'm not making any money, so like, you know, I don't need to do anything yet. But this is very important. Even if you're not making any money right now, you want to lock all these expenses, all these losses towards this future income. Because when he filed this tax return in 2023 for the loss of $300,000, and then this year 2024, this is when he came for me to review his tax return and help him prepare it. Now he's facing actually to have an income, because now they're doing very well and they're looking to have an income of $400,000. So now they have to be paying taxes on this $400,000. But then have they taking the advantage of the right entity classification in 2023, they could have taken this 300,000 losses, offset it with this 400,000 in income. And that is gonna generate, we're talking about like now they're in this highest tax bracket and they have to be paying lots of taxes on this 400,000. So we're actually talking about $90,000 that they lost just by not electing the right entity structure. So that's just how important it is. So you see, the key factor is to see, okay, am I okay to lose $90,000 just to save a couple of $1,000s in accounting fee?